Welcome to another episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan. Today, we're diving into some major developments in the mortgage industry that could have significant impacts on the housing market. This is episode number 88, and we're going to start off by discussing Canada's big mortgage moves and how they will impact the housing market. In our latest Move Smartly Ideas discussion, we assess whether the Liberal federal government's announced mortgage changes will help make housing more affordable as claimed. As the federal Liberal government makes some major mortgage rule changes this week to help first-time buyers and others being left behind in Canada's housing affordability crisis, my colleague and co-host, John Pasalis, and I discuss the impact of these moves in an occasional series we call Move Smartly Ideas, our chance to take a deeper dive into housing, economic, and policy issues. So let's break down what these changes entail. First, the government is introducing a new first-time homebuyer incentive, which aims to reduce the monthly mortgage burden for new homebuyers. Essentially, the government will provide an equity loan to help cover part of the down payment, thereby reducing the overall mortgage amount and making monthly payments more manageable. This move is seen as a way to help those who are struggling to enter the housing market due to high property prices and stringent mortgage requirements. Another significant change is the relaxation of the mortgage stress test. Previously, homebuyers had to qualify for a mortgage at a rate higher than what they would actually be paying to ensure they could manage their payments in the event of interest rate increases. The new rules will lower the rate at which buyers must qualify, making it easier for more people to secure a mortgage. This could potentially open the door for many who were previously unable to qualify under the old rules. However, these changes are not without controversy. Critics argue that while these measures may help some buyers in the short term, they could also inflate housing prices further by increasing demand. Higher demand without a corresponding increase in supply could push prices even higher, making homes less affordable in the long run. This is a classic case of supply and demand economics, and it's something we need to keep an eye on as these changes are implemented. John Pasalis, president of Relaxation Realty, has some interesting insights on this. A specialist in real estate data analysis, John's research focuses on unlocking micro-trends in the Greater Toronto Area real estate market. His research has been utilized by the Bank of Canada, the Canadian Mortgage and Housing Corporation, and the International Monetary Fund. John believes that while these changes may provide temporary relief, they do not address the underlying issue of supply shortage. Without increasing the housing supply, affordability will remain a significant challenge. So, what does this mean for you if you're looking to buy a home in Ontario? Well, if you're a first-time buyer, these changes could make it easier for you to enter the market. The first-time homebuyer incentive could lower your monthly payments, and the relaxed stress test could increase your chances of qualifying for a mortgage. However, it's crucial to remain cautious and consider the long-term implications. While these measures may provide immediate relief, they could also contribute to higher housing prices in the future. In conclusion, Canada's big mortgage moves have the potential to significantly impact the housing market. While they may help some buyers in the short term, it's essential to consider the long-term effects. Increased demand without a corresponding increase in supply could lead to higher prices, making homes less affordable in the long run. As always, it's important to stay informed and make well-considered decisions when navigating the housing market. Next up, we have an intriguing story about a 34-year-old man from Hamilton, Ontario, who's taking a unique approach to home ownership. George, who earns $62,000 annually, plans to buy a condo outright with family money, steering clear of mortgage debt entirely. George works in digital marketing and currently has zero debt. He has managed to save $30,000 in a savings account and another $300,000 in guaranteed investment certificates, thanks to a substantial gift from his family. His financial journey, however, is influenced by his childhood experiences. George grew up in Halton Region, west of Toronto, where his family owned a booming tech business that eventually failed in the 1990s. This experience left a lasting impression on him and shaped his cautious financial habits. George recalls visiting his family's massive, ornate office space as a child, only to find it empty and devoid of employees after the business collapsed. Despite this setback, his family had saved enough money for his education, allowing him to graduate with a bachelor's degree in political science and postgraduate programs in journalism and public relations without incurring any debt. With $300,000 from his family, George has been diligently saving in guaranteed investment certificates until he's ready to buy a home. He currently rents a bachelor apartment in downtown Hamilton, where he spends $2,000 a month on rent. George had initially hoped to buy a house, but found it impossible to afford a mortgage on a single income. Instead, he's now focused on purchasing a condo, which he can afford outright with his savings. George's approach is driven by a desire to avoid the life sentence of mortgage debt, which he believes is especially challenging for single individuals. He's committed to buying only what he can afford outright, even if it means scaling down his expectations. His financial strategy is also influenced by his family's past, particularly the loss they suffered during the tech bubble. As a result, he keeps his money away from the risky stock market and invested in the safer option of guaranteed investment certificates. George lives a minimalist lifestyle, focusing on not buying unnecessary items and making the most of what he already owns. He spends money on dates, entertainment, and basic necessities, but avoids what he calls crap he does not need. For example, he still uses Bose speakers from the 1990s, which work perfectly fine despite being larger than modern alternatives. George's financial mantra is simple: if you cannot be rich, at the very least do not make yourself poor. This minimalist approach extends to his romantic life as well. George has had relationships over the years, but has avoided economically commingling with other people, which he believes has helped him save money. He notes that not everyone wants to live a minimalist lifestyle, and this can sometimes lead to differences in expectations, like wanting to go out for dinner frequently. Overall, George's story is a compelling example of how personal experiences and family history can shape one's financial decisions. By choosing to avoid mortgage debt and live minimally, George is taking a path less traveled, but one that offers him peace of mind and financial security. It is a reminder that there is no one-size-fits-all approach to homeownership, and sometimes thinking outside the box can lead to unique and effective solutions. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found these discussions insightful and thought-provoking. Until next time, I am your host, Steve Hamilton, reminding you to stay informed and make well-considered decisions in the ever-changing world of real estate. Thanks for listening.